So this video is going to one of my loyal subscribers. He actually wrote me directly to my inbox saying that I am a 9-to-5 worker, but I really love to trade. How can I trade the market whilst I'm going to work? So basically this strategy is going to be leaning much more on the swing side so that you won't have as much interaction with the markets and you will limit the amount of time that is going to be required for your analysis. Without further ado, let's jump right into the strategy. All right, so basically the strategy is going to be on the H4 time frame. It is the time frame whereby we do not have as much, or we do not need much time to analyze the markets. What are we going to do on the H4 time frame? In this instance, we are not going to require any indicator, but basically our candles and our charts. All right, so basically what we are going to be using is to count 3 weeks of rise or 3 weeks of drop. When we shift the markets to the H4 time frame, we will have the market segmented in weeks. Like in this scenario, these black traces will mark a period equivalent to a week. So when we have 3 weeks in one particular direction, we expect to find a reversal. But unfortunately, we won't be there to get this reversal in time, meaning that we will require to be in front of the charts. So to remove that, what we are going to be requiring is these steps. So the first thing, when you're analyzing, probably after you've come from work or during your free time on the weekend, you need to mark these impulses to the upside, which I call levels. So if we have 3 impulses, we reach what we call an H4 peak, or usually the high of the month. So if we get high of the month, it means we now have a higher probability to have the market move from that high of the month with much more impulsive strength. So we had 1, 2, and 3, and we reached this particular point, which created this double top. So all that we want to create is a double top on the H4 time frame that has resulted from 3 impulses to one particular direction. After having that double top, or basically an M pattern, the next thing is now to anticipate retracement of the market to the neckline of that double top, meaning that we are, in other words, we are saying a retracement to the region of the high of the month neckline. So this is high of the month of December in this during the time of recording this video. This is the high of December, and after that high of December we created this neckline, first leg, second leg, and from that neckline, that is where we are going to have our zone of supply in the following month. So you can see that within this particular case, we had our zone of supply right here, so that we can actually start to look for sales. So the market has not yet retested this properly. So if we come back to this particular point on Euro odd, we can actually go in with our entry to the side, to the short side. So that is how you will be actually trading. So to master and understand this in more detail, let's have more examples. This is EuroCAD, and on EuroCAD we've said the first thing is to always count so that we have a proper high of month or low of month. So we had 1, we had 2, and then we had 3. When we have 3 levels in one particular direction on H4 time frame, we reach the high of month. This was the high of December on EuroCAD. After having that high of December, we had a beautiful double top, which is a beautiful M pattern. After that M pattern was issued, we can see that protruding it into the future, we had a beautiful M pattern, or basically this bearish engulfing pattern could give us a proper entry point, and our entry will be right at candle closure of the H4 time frame, since you will be tied up with work. So our stop loss right above the zone of entry, and then our target should be twice what we have risked. So in this scenario, we were going to have our target around this particular point, and we had money out of that particular trade. Have another example. We can see that in this particular instance, we have, so this one is an example that is in a live chart. We have been issued 3 levels to the upside. You can see that we have on card JPY, we have one first week that rose to the upside, second week that rose to the upside like that, and then we had the third week that rose to the upside basically like that. What are we now waiting for? We are waiting for the market to actually give us a drop to the downside. So we want the market to give us a drop to the downside, and after giving us a drop to the downside, if this is going to hold as our neckline, it means that we want a scenario which will actually give us something like this, and then we trade and hold, because this is likely to be the high of January of this month. So this is what we would like to see. So basically, that is how you will be trading using this swing trading strategy if you are someone who do not have access to the markets for a long period of time. You can actually refine this particular trading strategy using the course that I teach in depth on how to trade these particular cycles, which is called the Top 1% Trader. I'll leave the link in the description box below so that you can be part of the winners. And I have confidence in that particular course, because if you do not make money in 2 months, I will give you back your registration fee. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the next one.